Thinking of buying UK property through an offshore company? A few years ago, this was the go-to strategy for high net worth individuals. Set up a BVI company to buy UK property, pay no CGT on sale, and if you were non-domiciled, the property is outside of your IHT estate. The only downside was annual offshore company fees, which back then were pretty low, but these days are long gone. The annual tax on enveloped dwellings, or ATED, came in 2012, which is an annual charge where a company owns a property, though there is an exemption if it's rented out. The non-residence capital gains tax was introduced in 2015, meaning the sale of UK property would be subject to tax, and no more tax-free disposals. And to make matters worse, the inheritance tax rules changed in 2017, meaning property-rich companies, even if they were non-UK companies, which would have been subject to UK IHT regardless of domicile. The only benefit that remained was privacy. If you owned an offshore company, your name didn't appear on Companies House for all to see. But even that was changed with the Register of Overseas Entities brought in a couple of years ago. So is it worth it? All the tax benefits have disappeared, and while the annual offshore company fees have risen and can now be a few £1,000s a year depending on the offshore agent, you might still have a commercial reason for setting up an offshore company. But if you are considering it, make sure you get advice early so you know all of the tax implications ahead of time.